The Community Reinvestment Act is a federal law that encourages financial institutions to meet the credit needs of low and moderate income neighborhoods. What is the Community Reinvestment Act? The Community Reinvestment Act, CRA, is a federal law enacted in 1977. The federal banking agencies or regulators responsible for the CRA are the Federal Reserve, FRB, the Federal Deposit Insurance Corporation, FDIC, and the Office of the Comptroller of the Currency, OCC. These regulators review banks' lending records. This assessment evaluates how these banks fulfill their obligations towards low and moderate income neighborhoods, such as approving mortgage loans to qualified borrowers. The Office of the Comptroller of the Currency claims that by promoting the availability of credit and additional banking services to low and moderate income individuals, banks can help rebuild, revitalize, and reinvest in these communities through sound lending and good business judgment that benefits the banks and the communities they serve. Redlining. Redlining is the active refusal to offer home loans in specific neighborhoods based on income, racial, or ethnic factors. This term stems from the practice of some lenders who used a red pencil to outline these lower income neighborhoods that were deemed too risky. The CRA protects qualified individuals with sufficient finances and credit from being denied a home loan for living in these areas. Banks' incentives. Banks were incentivized to do well on these assessments to get approval to grow its business. Their CRA score is heavily weighed when evaluating applications for future bank mergers, charters, acquisitions, branch openings, and deposit facilities. No ratios or benchmarks. The Community Reinvestment Act does not prescribe ratios or benchmark regulators that banks have to meet. Instead, the assessment looks at lending activity and other data. No high-risk loans. The CRA clearly states that the bank's activities must be consistent with safe and sound operations. They should not make high-risk or subprime loans that endanger their financial stability. Bank ratings. Each bank receives one of the following scores: outstanding, satisfactory, needs to improve, substantial non-compliance. These CRA ratings are published online. Additionally, banks are required to provide consumers with their evaluation upon request. Exemptions. The CRA applies to FDIC-insured depository institutions, such as national banks and state-chartered commercial and savings banks. On the other hand, credit unions backed by the National Credit Union Share Insurance Fund, NCUSIF, and other non-bank entities supervised by the Consumer Financial Protection Bureau, CFPB, are excluded from this federal law. The Community Reinvestment Act and mortgages. The CRA is not a loan program. Instead, it is a set of guidelines or rules that encourage banks to make loans, including mortgages, to low and moderate income borrowers. Instead, there are particular loans, such as FHA loans, and loan programs such as Fannie Mae and Freddie Mac loan programs that may be available for low to moderate income homebuyers. Contact a local lender in your area to find out your options and ask if you qualify for any additional local or county housing incentive programs. For additional information, stay at FHALoanSearch.com.